Let me begin with Mr. Hughes, because you've just successfully brought issues to the market. And many of the points you've made, I think, echo a lot of what has been said before. But let me begin with a point which I think is several people have reflected. If we had good underwriting, we wouldn't have a lot of these problems. In some respects, a lot of what, from my view, Dodd-Frank is trying to do with skin in the game, et cetera, is just forcing good underwriting. So if you could just address from your perspective that issue, and anyone else that has a point about the, there's one view that perhaps we're creating this elaborate structure to force good underwriting where we could do something more specific, more direct, or the market eventually with other sanctions would be doing better underwriting. But Mr. Hughes, please.
Yes, I believe everything starts with the borrower and obviously walks through the chain. I think, not to oversimplify, I think actually the problem is not as complicated as all the regulations and everything we're going through. If we start with a process where the borrower has a down payment, the borrower can clearly afford the loan for day one. We don't create mortgage products, neg-ams and stuff that would extend the reach of that borrower. There's responsibility in communicating with that borrower between the lender, and then to the extent the next step is when the lender, if it does go to securitize, there's total transparency. They have skin in the game. I think you can go back, we went 20 years at 10, 15 basis points of loss in the prime. It's just reflect on what changed. And to me, the one thing that it changed all the way up from borrower down payments, no terrible underwriting, and all the things that have been well documented. From our standpoint, the one thing that is missing here is seconds. And we've been talking about it. I don't know how it, I've heard about St. Germain in this law and why it can't get changed, but that's a big thing that, from a borrower standpoint, that's still out there.
Let me just follow up with one question. I read your testimony that you basically, you insist on sort of skin in the game, taking it yourself as a way, I guess, to ensure your fellow investors. So you have no problem with at least the concept under Dodd-Frank of making, of the
correct
person taking skin in the game.
Yes, as part of our business model, and again, we're on the prime jumbo space. We think the most significant and best way to provide skin in the game is to hold the horizontal slice. I know there's a lot of confusion between subprime structures and prime. But what our sales pitch is to you is that, we put this deal together. We're selling you securities, and then we'll hold 5% of the securities underneath you. And to the extent something goes wrong, 100% of that is on Redwood. It's on our checkbook, our bond. It's not vertical where we get 5%. I think that, along with the disclosures, in the transactions we did, it wasn't, the first one was 6 times oversubscribed. So to me, it goes to show it can't be subprime, but if you meet what investors are looking for, the borrower has skin in the game, and throughout the chain, I don't think it's as difficult as all this, at least on the prime side.
Thank you. Professor Schwartz, in your testimony, you talked about many different factors, and some of which were our intra-company, which were not being dealt with directly today by us, obviously. But one issue I think that comes, again, it resonates throughout all the testimony, is the complexity. The market went from pretty simple stuff to CDO squared and cubed, where you would take the lowest tranches of a mortgage-backed security and then combine it into something else and miraculously come up with another security that had at least a component that was AAA rated. I guess, and I think what Mr. Katopa said too, if it's standardized, if it's simple, it'll work. Should we be spending more time? Will the market, let me put it this way, will the market permanently reject this complexity? Has it learned a lesson that, keep it simple, stupid? That's what I learned at Fort Benning. Or are we going to see, if we don't have some of these very elaborate rules promulgated by the agencies, a quick return to super complex and issues that can't be understood? So.
It's a very good question, and I think that certainly in the short term, the market is going to reject the complexity. I fear that in the long term, as yields go higher on very complex products, the market may find them very attractive. And in my written testimony, I talk about how the intra-firm conflicts like issues of VAR can facilitate this. One thing that, just a couple of thoughts here quickly. One thing is that because complexity will be inevitable, I think that failures will be inevitable. I have a paper that's cited in these materials, Regulating Complexity in Financial Markets, where I develop this at great length, and I compare it to chaos theory and complex engineering systems, where failures are also inevitable. So the question is how to address this, and you address this in part by trying to mitigate the failures, but also you address it in part by trying to mitigate the consequences of the failures when they occur. And this is something I think we need to do. A couple of other thoughts. In a perfect market, the investors themselves would be understanding what they're buying, would be insisting, in fact, that the originators, the underwriters, really retain skin in the game. In my experience, for example, in many loan sale markets, you wouldn't have a bank buyer participation in a loan unless the seller of the participation retained at least 5–10% interest in that loan. And so one of the questions I think we need to fully understand is why did the system break down here? And I think part of the answer is that things, again, have gotten too complex and that disclosure is an insufficient answer. Part of the, the question also is that risk has been almost marginalized. And this is interesting. Most of the investors are the hugest investors. Many of them are QIBs, qualified institutional buyers, who are freely allowed to buy and sell securities under, the SEC rules. And so, it's something we need to look at. A final thing is that I've thought a lot about whether we should try to standardize these complex deals. And in fact, one of the speakers talked about standardizing in the RMBS field, issues of the pooling and servicing agreement and so forth. Standardization certainly can help in the very short term, but I fear that in the long term, it would really stymie the ability of our financial markets to innovate and grow. And so I'm very concerned about anything of that nature. Thank you.
One of the issues that Senator Corker's line of questioning raised was we've seen the asset-backed security markets in automobiles and other areas come back rather, if not robustly, at least come back. We haven't seen that in housing, and the issue, the implication at least, and I think it should be made explicit, is that a lot of this is not some of it's related to the uncertainty with respect to these rules, but a lot of it is related to the role that GSEs are playing in terms of their guaranteed fees, below market rates, we would suggest, the fact that they can insure or guarantee to a significant amount now, that's going to come down. And I wonder, just Mr. Hughes, sort of your estimate of, is that really what's holding back the private market now, or is it more this issue of what will the rules be in 2013?
Yes. So if you were to look at the market in 2010 in terms of, the pieces of it, and actually the amount of loans under 417, the old GSE rate, is 90%. So if you went down to, rolled it back to 417, it would be 90%. So they are financing now the additional amount between 417 and 729 is another 5%. So the amount that is really only available for people like Redwood is the top 5, and it's even less than that. And the reason it's even less than that for an outside securitizer is if you look at the executions, for a bank today, if you are awash in liquidity, you can sell 90% into a government bid. You're sitting on excess cash. A 4 or 5% mortgage sounds pretty good than trading it over for 25 basis points or something else. So they're retaining it. So there really isn't any financial incentive in the system to get it going. So that, investors, there's really nothing to kind of put together.
But let me follow. When we begin this process, you suggested, I think, the first step, obviously, is in lowering the maximum amount that can be guaranteed. When we start doing that, you expect the private market to come in. And I guess the question that's before us today, that we've got to get these rules right. But the biggest thing at the moment, macro issue, is just the sheer presence of GSEs in the marketplace.
Correct. And even if it did come back to 629, I think the amount that it would probably add out there would about 3% is all I think it would come down to when you come down, because 5% was 417 to 729. So for all again, the fear, if we go down, you're going to take away what is outside the GSE's reach, about 2%.
Ms. Prendergast, and the issue of reproposal presumes that very little of your you don't feel that your comments will be adhered to, because I presume you've made numerous comments in this process, not you personally, but the industry. But can you give me an idea of why a reproposal, in your view, is necessary, since the final rules have not been proposed, as I presume, that you'll also have a situation where the implementation will not be till 2013. So that seems to suggest that there will be time even to adjust the rules if they're proposed. Can you put it on? Yes, ma'am.
I think the concern is that there's a lack of clarity as to what some of the proposed rules are suggesting. And I think that's one of the things that, yes, we can comment on the rules as they stand today, but we're not sure exactly what we're commenting on. For example, the premium capture cash reserve account, the reserve account, is something that we have been discussing with regulators, and yet it's still not clear specifically what the intent was of that particular provision. What we do know that, as written, it does take substantially all of the economic incentives to be involved in this sector out of the market. But in conversations, what we've learned is that we think that it is much more akin to wanting 5% of the proceeds, not 5% of par value. So real 5% skin in the game.
But you have made that point, as you're making it today, very well. That's why I think this hearing is very useful and very important. You've made that point as clear as you can to the rule writers.
Correct, but it's not 100% clear to us that that's the only component that of the
Right.
premium capture cash reserve account.
Thank you. Mr. Katopis, you made some interesting comments to respecters of the investors about standardization, transparency, and also the need for services, and I think Mr. Hughes made similar comments, services to be much more flexible in terms of dealing with mortgages. Can you elaborate on that? Because frankly, from our different perspective, that is trying to get a bottom under this foreclosure problem, we have been, at least figuratively, banging our heads against the issue of services, their incentives, their relationships, as you allude to some of their affiliates, et cetera. So I would be benefit from your comment.
Thank you, Senator. I could go on for a long time about this, but in brief,
You have 1.2 minutes.
I'll do my best to explain again and refer you to the written statement that we share the frustration that many consumers have regarding servicers, improper servicing standards. The servicing model was not designed for the default rates we have today. We urge you to take a look at the potential conflicts of interest when servicers own seconds, stand in the way of modifications. And one of the things I do is try to debunk the urban myth that mortgage investors, as first lien holders, try to block modifications. Just to go on the record again, we would like to see responsible, although distressed homeowners stay in their homes. We'd like to work with them on the modification process. We think there are benefits for the homeowners, for investors, and communities through that. And I refer you again to our written statement and our 10 points in the white paper.
Have you communicated these concerns, particularly about services, to the Federal Reserve and the OCC, who regulate most of the services?
In December, we reached out to regulators in support of national servicing standards, and we have also communicated our concerns to the CFPB and state attorneys general.
And have you got any feedback or any sense of you're getting traction or not?
I think there's widespread acknowledgement of some of the defects of the current servicing model and the abuses that are going on. We await further action on that.
I am similarly positioned.